You're listening to the REITE Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at thereiteclub.com. And now your hosts, Sarah Larby and Alfonso Salemi.
But it is quite interesting. Like, obviously, it seems like you've developed something great. Okay, I have some questions for you, though.
Sure, absolutely.
Okay? So let's just say the market takes a dip in general. So one of the things I don't like about paper assets, not all paper assets, but most paper assets, I don't have control over it, right? So like, for me, if the market takes a dip, the real estate market, my tenants are still living in there. They're not going away. There's going to be more need for renters anyways in rental properties. So, and I cash flow, I won't care. But you don't have that with paper assets. Is that correct?
Absolutely. And I have the exact same mentality as you. Like, this is one of the problems with people being able to stomach the stock market is the volatility. Like, for example, I often wake up and I have positions that are down 30%, right? And if you had one position, let's say you just owned a stock and you had $100,000 and it was down 30% the next morning because of a news release, you're holding your stomach like it's painful. So basically you have to treat the market like a casino, the way the casino does. So a casino doesn't know if it's going to win on the next hand or not, but it knows it has an edge in the market. It knows that in the long run, if it does enough bets, that it's going to win more than it loses. So what ends up happening is over the long term, that probability is in their favor. They have an edge and they're going to make money in the long term. So essentially what happens is you have no idea, you have no way of knowing what's going to happen on the next trade, but you know if you have an edge in your trading system that over the long term you're actually going to make money, right? And you don't need to know what's going to happen next. So the other thing that we do is we like all trading systems take drawdowns. And this is something that's hard to stomach as well. But for example, you might have a system that makes 20% a year, right? But at its worst, like if you test it, like what it's done over the last 20 years, maybe it's had a 20% drawdown at one point in time. So at some point you might experience, a 20% drawdown in your account, but there's people that trade this way all the time. And as long as your system keeps working in the future, you're going to recover that money and you're going to actually go on to make new equity highs, right? So what that means is essentially like, this is why it's so hard to trade, because you don't have the confidence in knowing that things are going to start working again. So what we do is we have what are called filters in our trading systems that if things get really bad, like the global financial crisis, we might take a 15 or a 20% drawdown from our peak equity amount, not from our starting equity. So let's say we started out with 100,000, maybe we're up to 200,000. At some point, it might come down, 10% or 20%, and then our system might shut off and wait for the market conditions to return to a sustainable level. So those are things you have to be able to stomach when you're in the market. And it's normal. Like, you don't feel that with real estate, because what happens with real estate is if my property is worth 20% less tomorrow, I don't care because it's cash flowing and I'm renting it out. But in the stock market, this is normal. Like, if you look at just buying an index fund, for example, you're essentially risking $50,000 to make $5,000. And the reason why that math works like that is because if you owned stocks during 2008, during the GFC, the global financial crisis, at some point your index fund would have been down 55%, right? Now, if you fast forward to today, it's recovered, but what we do is we build systems so that we can beat the market, right? We can beat the averages of the market with lower volatility. And that's usually our goal. We want to get better returns than what an index fund will offer or what the general market will offer, but we also want to have lower volatility. And that's kind of the goal that we look for.
That's cool, Dave. I mean, you're really clearly really passionate about it. And like, I know you work super hard, and like, so you don't have a full-time job. You're in real estate and you're doing this trading stuff. Mm-hmm. When you look at it, what creates the majority of your income? Is it real estate or is it paper assets?
I would say, like, I don't consider myself like I wouldn't say that I'm successful. I'm sort of a long-term student of markets. I'm always learning and I'm always trying to develop new ways to make money. So I kind of have this triangle approach where I think the way that you need to make money is, and going forward is like you've got real estate on one edge of the triangle. You've got
That's my edge of the triangle, people. My edge.
Yep. You've got you need more edges of your triangle, right?
I'm just kidding. I'm just kidding, but that's my favorite edge.
Oh, you know what? I couldn't tell you if I like stock trading or real estate more. I like them both just as much. So then you've got stock trading, you've got, what I call systematic investing, and then you've got like an active business, right? So you guys, I think both are in the sort of active business camp and you're in the real estate camp. So maybe you might want to round out some of your investing doing stock trading just because it will sort of diversify your risk a little bit and give you more opportunities in order to, more opportunities to exploit. Yeah, and I think that's what it's all about.
Yeah, and you know what? Don't even limit it to a triangle. Let's get some ninja stars out there, right? With
that's great, yeah.
5 and 6 and 7 different sides, right? There's multiple streams of income.
Absolutely.
There's passive income, the active income, and like you're saying, systematically. And so with those programs that are so readily available, and you see the commercials in between hockey games and stuff like that, the Quest trades of the world, and like at the apps at the end of your fingertips, it's almost like I compare it to almost like, like live sports betting, right? In some cases, right? Because you can monitor it throughout the day, throughout the term. But from the sounds of what you're saying is like, it is more of that longer term approach, that's systematic, that if you're doing the right things, putting at certain points of the time, more often than not, you're going to get it right more than you get it wrong. So how does that somebody with all that noise in that market go out there and say, and focus on that and do that from a starting point?
Well, I think like for me, what it took for me, and I think what it takes for a lot of other people is, when you're a systematic trader or investor, like a lot of the stuff that you see on TV and all that stuff, it's all bullshit. Like they don't know, they tell you, well, you should do this and you should do that, but they have no statistics and no data to back it up. So one of the things that we do in the systematic community is we will actually program our trading rules against proper historical data. And I won't get into the nuances of what that is because I don't think your audience really cares about all the technical details. It's just like, what's the end result? So essentially what we do is we look at how our trading rules would have performed 20, 25 years ago, how they would have performed in different, what we call market regimes. Markets have different behavior. So how did it perform during the 2008 financial crisis? How did it perform in the dot-com era, right? When things were going down.
Actual simulations of what actually
simulations.
Happened. Wow, that's pretty
cool. And what we can do is we can see what the equity curve looks like. We can see what our maximum drawdowns were. We can see like I'll give you an example. Like I know when I trade a system that, let's say if I'm going to trend follow. So trend following is where you just, like if you look at the stock market, it's been going up. You just get on that. It's going higher. You just jump on that wave and you just ride it as long as you can. That's basically trend following. So I know that, let's say a good trend following system will only be right 40% of the time, right? Maybe 45% of the time. But what I do know is that when it loses, let's say it loses $1 when it loses, well, it might make $2.50 or $3 when it wins. So every trade that loses might lose, $1 in comparison, and the winning trade will make $2.50 or $3. That's how you make money trading. You want to get close to 50% accuracy. You don't always have to be right. Some successful traders are only right 3 times out of 10 on average, but you make a lot more on your winning trades than you do on your losing trades. Now that's for a longer term system. We also have some systems because people like to be active and they like to get out of the market if the market turns on them. So like I have my friend Gary, who's actually putting his trading signals on my Systematic Investors website that we're launching. People can subscribe to that. It trades every 4 days. So he'll be in a stock, he'll buy a stock on the NASDAQ, and within 4 days, he'll be out of it. So what ends up happening is he has a higher win rate. So he might win 60 or 70% of the time, which, for people's psychology, for their emotional management, that's a lot easier to stomach. And so you got to find what you're comfortable with. Like there's a lot of different systems that might work, but they may not work for you if you're not comfortable executing them. But
Yeah.
you can look at all the stats.
Thanks for listening to the REITE Club podcast and joining our community of real estate investors online at thereiteclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.